Santosh Rao is joining. He's the head of research at Manhattan Venture Partners on the phone to help us dissect what happened. Good to have you on the program here, Santosh.
Good morning.
So tell me, the big takeaway here is what? That Uber just continues to bleed out money on a bottom line basis?
Right. Yeah, so it was a beat and raise quarter. So that's a step in the right direction, but still has a long way to go. The losses are still very high, and they're working it down, but it's going to take some time. The big issue with these ride-hailing companies, particularly Uber, is to win back the trust. People don't believe it now with all this WeWork and all the other stuff and all the pullback in the stock since the IPO. They need to win back the trust, and that's going to come with good execution and good movement towards reaching break-even or EBITDA positive. They said 2021, but I don't think there was that much conviction as did Lyft. Lyft is much better. We are investors in Lyft. We believe they have a much clearer path to profitability. Lyft has work to do. Uber has work to do. It's a longer-term story. Lyft is more a shorter-term story.
This is a really important point because the two had been trading basically hand in hand. And today, and really since Lyft's CEO discussed the profitability timeline, even though Khosrow has done the same and highlighted 2021 as their goal for profitability, the shares now are separating. We've got Uber down 6% this morning. Lyft is hanging on, only down 1%. Are the ancillary businesses that Uber has tried to sell investors on as being a positive, Uber Eats and such, are they right now a burden?
Absolutely. And I think at some point they will have to divest some of those businesses. They all, you saw with Grubhub, all the delivery companies, they took a gut punch last time with the Grubhub reporting. So I think that's the story there. These are good services, but as standalone businesses, they are not really good, viable businesses. The pricing is an issue and so many other issues, and the regulators are on the back now. They're all watching this whole area. And in a way, this whole gig economy companies are in the second phase of their evolution, where now they've established their presence. Now the regulators are coming on, so they're going to layer on additional costs on them. So they have to protect the value proposition that they have. So if they don't execute well, they have a problem. So with the Uber's case, they're in too many businesses, in all competitive businesses. It's going to take a long time for them to really get it all together and turn profitable. And international markets are highly competitive, especially Latin America, India, and the Middle East, which is their growth markets. So just because the size is there doesn't mean profitability is anywhere close, because the competition is very intense outside.
Let's talk for a sec about the top line instead of the bottom line, even though the market is obviously focusing on the profitability. Santosh, when you look at the actual rides and you look at the active riders and their market share, is that part encouraging? Is Uber growing fast enough even with the competition? Because it's not just Lyft. A lot of the cabbies now in major cities are offering up alternatives too to the traditional business. Is the top line good for Uber? Are we happy with the overall sales growth?
Yes, I think it's definitely in the right direction. The ride-hailing part, which has the best unit economics, especially in North America, where Lyft is focused, that's a good part of this whole business. And so they're executing well there. They're hitting a lot of large numbers, but the market is still very big. It's not a zero-sum game. There's still the end-to-end connectivity that they want to do. It's still a long way to go. Plus, micro-mobility is still coming in. They haven't layered that in, so that's going to come in also. So both the companies, they still have a lot of room to grow and kind of establish the presence. So top line, they're in the right direction, definitely. That's the bookings are up, plus or minus. Lyft is more aggressive there. They're taking market share from Uber because they're more focused here. That is their only business. And the next leg up for cars is going to be autonomous cars, and Lyft is razor focused on that. So I think that's where you need to allocate your resources, and Lyft is in a better position. Uber is more kind of scattered in that sense. A lot of business to invest in. So I think that's where the trust factor comes in. Can they deliver? And we don't know how long people are going to wait. Is it going to be 5 years before they really get it all together? They're good businesses, but it's going to take a long time. Lyft is much narrower in that sense.
Santosh, before we let you go here, the company still has billions of cash and equivalents, about 13 billion that they can still put to use. Is the language that you're hearing from Khosrow and the leadership at Uber realistic? They're talking about continuing to push against the legislative problems they've got with the employees, but we don't hear a lot about the automation side, and there's still many analysts who say has to be an automated business for it to make sense. What do you think?
Yes, I think Uber has had its problems, its growing pains, so to speak. They got distracted, they got sued, so they were held back a little bit. And I'm just comparing them to Lyft. And Lyft was more, they invited third parties, they have a relationship with Waymo. They're being more realistic and more focused in that area. So autonomous cars, the investments is going to take a long time. They need to get it right because that's the next leg up. But that's a few years away. It's not going to happen overnight. But they need to be prepared for that. And Uber, I strongly believe that it has the money, and that's why they raised all this money, but they need to manage it well, they need to execute well, because every business that they're in is very expensive at this point.
All right, Santosh Rao, really good setup here for us. We're going to do some trading here. Santosh is the head of research. Great. Thank you, sir.
Thanks, man.
At Manhattan Venture Partners. Tom, let's get straight into it. So Uber to the downside, how would you put that on options right now?
Well, I looked at it more of a neutral type strategy here because it's pulled back so much.
It's holding at 29 too.
Yeah, just about 29 after this earnings report. The key thing is, and we didn't even mention it, is the fact that they've got the lockup period ending tomorrow.
Right.
And the amount of shares that are supposed to end their lockup, there's a discrepancy there between like 600,000, 1.2 billion or 1.2 million.
Okay.
So it depends on what comes out of there.
Sure.
So I wanted to look at something neutral, and they're using options and just doing a simple calendar spread. We've got volatility, implied volatility getting crushed this morning after the earnings report, even though the stock's down a little bit. So what I looked at was a simple 1 month wide, medium term type trade using the 30 strike on the call side because it has held that 29 level here. And you're buying the December options, about 45 days to expiration, selling the near term November 15th monthly expiration, and that same strike, the 30 strike call, you're paying roughly about a 90-cent debit on this 1 month wide call calendar to the upside slightly. But you see the break evens there, Oliver. You got about $34 on the upside and about $27 on the downside. So it's still range bound, even though you're picking that 30 strike. It's better to initiate these calendars during low volatility environments because the cost is less on that. You got a nice wide range in this one, but this takes advantage of that Uber's going to settle down here over the next month and a half. And you have that ability to roll your short option, the November monthlies, week after week to collect credits to reduce your profit or increase your potential profitability and reduce risk every time you do roll that. And those rolls can expand to anywhere between 30 to 50 cents. So you only need a couple rolls, take care of that price of the calendar, and then it's all profit after that. But you do need to be at or near that 30 strike.
So 27 to 34. 27 would be a new low for Uber. So you've got some pretty good, I think, support on the chart for the range. How about Lyft, though? Because Santosh sounds much more positive on Lyft, as many are starting to tilt that way.
Yeah, I think a lot of people are because of the drag that Uber Eats and some of the other satellite type of entries into that platform that Uber's trying to do. It's actually costing them money and not profitable at this point. So I looked at in Lyft out to the January cycle. So I wanted to give myself some time. This guy has about 73 days until expiration. You're basically buying an at-the-money call here, the 42.5, and then to reduce your cost on it, you're selling the 47.5 strike call. So you're creating a long, bullish call vertical to the upside here on this name. You're paying roughly about $1.90 debit on that spread. So you see the break even there. 42.5 plus what you paid for it, so 190. You got that break even at 44.40 to the upside. So you need to move about 3 or 4% higher, but what you're giving yourself is duration. Now, that same spread in the December cycle is only about 20 cents cheaper. So extending it by paying a little bit more for that makes it more beneficial because you have more time in this, and it's purely directional where you need it above that 44.40 at expiration. But if it goes up to $44, maybe that thing expands to about $2.50, $3. You can get out of half of your position, but that's purely directional, taking advantage of lower volatility in these names based on earnings are already passed.
Sell the call that's further out, buy the one that's closer in. Tom White, I like it here with the trades here on the two big ride-hailing names.